All right, just hit the go live button. Guys, let me know if I'm coming through nice and clear to you. And are you ready for FOMC? Alrighty, hello everybody. My name is Joe Baus. I'll be your boss for the day. Going here into FOMC, the consensus is we're gonna get 25. Actually, no, we're not gonna get anything. We're gonna get no hike. It's gonna be flat. Then Powell's gonna come out and do his hawkish, song and dance. I ain't buying it. I haven't been buying it since last week with US CPI. No, not US CPI, that too, but US Services PMI. Hello, nice to see you guys in the chat. Pascal, Shell, nice to see you guys. Always in there. Absolutely love it. And more people are hopping into view. As we go along, we'll get more guys hopping in. But yeah, we got quite a bit to talk about. And I kind of have myself on the lines here. Because my expectation is for a hike, right? And if you're looking at the FOMC, what is it, the CME Fed Watch Tool probabilities, oh, the Fed's never surprised before, right? The Fed's never surprised before. We're 95% certain that the Fed is gonna do nothing. Really? Really? Have they seen the price of oil in the last 48 hours here? Have they not seen the price of oil? I don't know about you guys, but the last 3 months, a big component of why inflation has gone down is because of energy. Right? It's been going lower and lower and lower all throughout this month of June. It had a hard time throughout this whole month of June. It had a hard time all throughout this month of May. I mean, look how choppy May was. It started out low and it ended low. I don't know. Does the Fed want to give oil some relief by holding? Because if the Fed holds, oil will go back to the top end of this range. Oil will go back to $75 very, very easily. Now, while I am a hawk, I am expecting a hike, personally. Just FYI, all that stuff, the way I'm positioned, I'm totally risk managed. I'm not going to be getting, a huge haircut. I'm going to be getting like a trim off of like a part of my back of my hair, which I probably actually should, right? I'm just going to get like, a little something something. I know exactly what I'm doing, right? Unless you've already figured out exactly risk management, right? I mean, we can maybe go over some of the things that I'm looking at when it comes down to range probabilities and pivot probabilities, right? We hit some threshold levels of pivot probabilities. But I think I'll leave that for the trading group, right? If you want, we'll go through some of these indicators for the day. But what I'm talking about are like indications for the entire week, right? Risk levels for the week. We'll look at risk levels for the day on a few assets. We'll cover oil, we'll cover the FX pairs, we'll cover crypto, we'll cover equities. Oh, and speaking of crypto, real quick, I'm just going to rub this in. It's in from yesterday. I called it in price and I called it in time. Oh man, just what a little bit of plan the profit will do for your life, right? Just what a little bit of planning to profit would do for your life, right? Those arrows, those time-stamped arrows, man, just can't help but look at it. It's like a work of art. It's what trading conviction looks like, right? When your trading conviction is based off some decent statistics. Not even the best statistics, just some decent statistics that you're interpreting properly. Now, the key thing for this stream is kind of going over, oh, I don't know if you guys hear that, but there are some jingling bells over here. Let's see if we can get the co-star on stream here. Hello. How's the girl? How's the girl? What do you think Powell's gonna do, kitty cat? Obviously, she doesn't want to do any trading. Look, like most people, you just look, if you talk about trading nonstop throughout everywhere you go in your whole life, people are going to get bored as all hell. That cat clearly did not want to talk about trading. Nothing will make the cats run away faster than trying to discuss your FOMC trading tactics, right? Yeah. Read into that a little bit more. Make the cats run away. Oh, man. Yeah, that's right. No, it's an Apple AirTag. She kind of likes to go outside, so every now and again we want to make sure we can find her. Yeah, Apple AirTag's a smart thing. A lot of people used to do tiles. We used to do tiles. We did that once with a dog. But the AirTags just work so much more easily. And because they kind of work with the signals from other people's iPhones too, they work in more scenarios. Anyways, look at that arrow. Oh, man. Was there any other assets I can remember? I believe I did NQ. Oh my god, yeah. So I don't think I get to call this. I mean, I was saying I didn't get to call it here, and I was saying I was wrong here, and then the thing came down exactly to where I was anticipating the low to be anyways, so... You know, before I said that this was a bad forecast, that was a loser, and I had to take the L on that one. But now, I mean, it's such a small move. I gotta be able to take the W on that one. I gotta be able to take the W on that one, right? For calling where the low was gonna be on NQ for that day yesterday. I was freaking close, like, come on. And it's correct in time as well. Like, come on. Come on. Oh, the kitty cats there. Kitty cats are playing over there. So if you hear a meow or a chatter or a couple of bells ringing, just know the kitty cats are playing on the other side of these monitors here. Alrighty. Well, guys, let me know how you're doing, what assets you're looking at in trading, and I'll show you what assets I'm looking at in trading, and we'll go over some risk management for those assets over the next, well, until FOMC starts, right? The next 45 minutes, which is over here. It's like 11. Yep, 11. So we got 35 minutes to go over any assets we need to go over for whatever risk management we want. So, guys, what assets do you want to cover? Let's go over to the chat. Eurodollar and dollar CAD, Pascal, of course. Those are the two assets I've been trading. And I am currently long the US dollar on both of them. And man, I am so glad I do my position sizing the way I do it. Because, I don't like even being in... Now, as I've been trading more and more, I don't even like being in, even a 50 pip drawdown nowadays. It's like either I'm using my indicators to catch the low, and every other day I'm trying to catch the low on those days too, or I'm wrong and it's going against me, right? And the macro research I've been doing and the outlooks I've been reading, are the expectations they have are kind of getting usurped, right? But let's go ahead and start this off with a little dollar CAD. So I believe, yep, over here, I still got, so here's the story of this setup. I got some longs here. We had our trade plan over here play out. I was contemplating adding over here, and I said, this isn't maybe the best place to add, in all seriousness. I have a very small amount of risk right now, and I kind of want to wait and see how things develop before I add more risk. I should have just exited this trade up here where I expected the top of the day to be. And then I would have had no risk, and I would have been totally neutral. But I'm like, I still got my expectation for a rate hike. So I went ahead and I held that. And I added just above 133, if I recall. If I can check out the trade group. Otherwise, I'm going to have to post a log here. Yep, looks like I'm going to have to... Oh, wait, hold on. I got to quadruple check. Oh, yeah. It was like right here at these tippy tops, so it's effectively the same price. It's not going to really look any different, yeah. Okie doke. So I got in a little bit right here, and then it's still continuing the fall. Net. The drawdown was at most 47, and at this point I'm like, oh, I'm wrong. I got to get out of here. But now it's kind of come back. We're in the 45 minutes leading up to FOMC. I'm going to be watching as FOMC comes out to see how I need to respond. Either get the hell out if it's flat, or the hike comes in and the little itty bitty risk that I have at stake nets me more marginal returns, because that volatility is going to definitely take care of my P&L, right? And that's what I'm counting on. I'm taking itty bitty tiny little risks on FOMC hike, and I have good research and good outlook reasons on why to anticipate a hike, right? A non-consensus hike at that, don't just take my word for it. Some of the smartest people who I listen to are still saying, there's still chances that the FOMC hikes. And then some of the people who are like Fed watchers for the last 30 years, they've been retweeting and tweeting out stuff that's all very hawkish. That's all anticipating a hike, a surprise hike. So I really wouldn't throw it out, right? I wouldn't throw the baby out with the bathwater, right? The Fed Watch tool is like 95% rate hike odds. But if you go and you look at betting sites, it looks like, 10% think that there will be a hike. And then on another side, you see like, 20% think that there's going to be a hike. And then you go and you check Twitter polls of just like anyone out there who's doing analysis, 300, 500, 1,000 votes. And it's split 50-50 between people who are expecting a hike and a pause, So between which metrics you're looking at for your sentiment and your probabilities, I'm like, there's a bit of discrepancy going on here, because typically when Fed Watch Tool has high accuracy, when I go and I check all these other sources of data, right? When I check, these betting websites, right? These binary event websites, they typically have the same odds as the Fed Watch Tool. When I go and I check these Twitter polls, they usually have the same odds as these Fed Watch Tools. I'm getting different odds from everything across the board. And don't get me wrong, there's obviously every single time going to be some variance, like 5 to 15% variance. But we're talking like 20+% variance across all of these metrics from all these different places where you're getting different polling. So I have a understanding that there's probably a higher degree of uncertainty as to there actually being a hike here. So you put on some minimal risk, right? And if the hike doesn't happen, guess what? It's minimal risk. What's 20 basis points, 30 basis points on a trade that has an expected value of maybe 150 basis points, right? Like, I'd want that trade, and those are the kind of trades that I'm looking at, and that's the sort of risk that I'm taking. So it's like you're exchanging, 20 to 50 basis points of your account on one solid trade idea, not like 20, 50 basis points of your account, per asset, right? You don't want overexposure. You want some diversification, But you go ahead and you get that exposure to that trade idea. And then if the trade idea works, you hit in, I'd say Twitterland, your risk to reward, your R to R ratio is definitely going to be above 3, right? You're definitely going to be making more than 3 or 4 or 5 to 1 for the risk that you're taking. And I got my other chart open here looking at my accounts, and I'm seeing things in the last, I'd say 15 minutes have sort of improved. We got 27 minutes until FOMC. So let's go ahead real quick, bring up the range probabilities. So real quick, anyone who is familiar with range probabilities would have already seen this coming. This is probably going to be your bearish threshold right around here. Most of your lows for the day, if I highlight this spot right here, this is telling me that, what is it? Right here. Yeah, this is like 83. It just updated on the bar update. Real quick, I'm just going to refresh all the indicators one more time. Alrighty. Yeah, it's somewhere between 75 to 80% of the time your low for the day on dollar CAD for any given trading day occurs above this line, roughly around here. Now, here's one thing to take into consideration. This is data for the last 5,000 bars back, using a higher daily time frame. So this is taking a lot of data, and this is giving a good distribution of where the lows for the day typically occur for any given trading day. But this is not a normal trading day. This is FOMC. So one improvement that we could probably make to our interpretation is, what if we could only sample the FOMC days? What would that distribution look like, right? What would the distribution of the lows look like if we were just looking at the FOMC trading days? Now, I don't know if we'd have a significant number of samples. I assume that we would. But we would probably have a better representation if we had some sort of joint distribution between what this most recent data looks like and then what the events distribution looks like, if you get what I'm saying. But for now, with the information that we have at hand, I'd say like 123, 132.65 is gonna probably be your threshold, your bearish threshold. Based off the data we got here, yeah. So if FOMC comes in with a hike, then we're at least going to 133.4. We're at least going to 133. We're immediately going up 50 pips. But if we get a pause from the FOMC and we stay flat, we're probably going to break this threshold. I'd assume we're going to go below this line here. No, Princely, it's not an average. It's a entire statistical distribution that's calculated. So this is an entire probability distribution. Alrighty, let's go on to the next pair. Princely, you wanted pound. Manus, you wanted dollar. DJ Prosper, you wanted pound yen. Actually, that's going to be an interesting one. Let's check out pound yen real quick. Let's look at our distributions here, our risk ranges for CAD yen. I'm seeing some really good movement here on the portfolio going in here. Yeah, I'd be careful. I'd be careful buying any longs here on CAD yen. Roughly 60% of the time, your low for the day, well, 55 to 60, because the probability is updated in real time. So I kind of have to give a range, because as it recalculates the probability distribution, it's simulating the probabilities every time the bar updates with new data. So it's like somewhere between 55, 60% of the time, depending on the simulation, your low for the day comes in above this line right here, call it 104.95. And we're currently below that. It's going to be a bit harder to say exactly where the low is going to be. Since we're going into the end of day, I'd say you probably want to be looking at the closing odds here. Yeah, I mean, in all seriousness, I'm looking at this and I'm like, if you start going below 104.8, I couldn't tell you where the thing's going to end if you're going below 104.8. So I'd just be careful going long here. I'd be quite careful going long here. Let's see, what else is there? We got how many minutes till FOMC starts? We got 20 minutes until FOMC starts. So we can cover a lot more charts in 20 minutes. Guys, make sure to give me your recommendations for charts to look at, and give me your commentary and your feedback back on this analysis so I can answer any questions. So let's go on to the next one. Let's look at dollar yen, since we just looked at CAD yen. Now, personally, I think yen is going to get hit extraordinarily hard on a hike. Extraordinarily hard. But I have one little speculation that if the FOMC does hike, it is going to lead to a higher likelihood that the Bank of Japan does maybe some minor yield curve control at their next meeting, or gives some more hawkish policy statement saying, we're getting ready to make our surprise hike or something. But I don't even know if they want to telegraph that. The Bank of Japan is an enigma in an enigma in an enigma. we gotta be careful when we're talking about Bank of Japan here. We kind of have a gap here in the price. Let me see if I can squeeze that out of there. We want the indicator to start printing from right about there. Oh, that didn't make it any better. Yeah, this is a problem with the bounds of the distribution. Thankfully, I got the math for this now, so I'm going to be fixing this. It's just a visual bug. The probabilities are still the same, but it really indicator doesn't start right here, right now. It's going to be fixed in an update. Don't worry about it. The main thing that's important is just to know that, yeah, these probabilities are accurate. So we could do one thing. See if that fixes. Just change the time frame to a 2-hour. It'll load more historical data. It'll be more accurate anyways. All right. Hey, there we go. Yeah, it's a lot closer. Yeah, I'd be extraordinarily careful. Yeah, so once you start going past this 139.2 level, you are going to start dealing with tail risk to the downside. So on a cut, on a cut, but more like on a pause or a skip, if that's what the Fed's going to do, I would absolutely anticipate that these lows get breached. I would absolutely expect that. Now, as far as the upside goes, maybe it just makes a big bottom wick, right? Maybe you just go back up here for like another 100 pips or something. And this kind of leads back into why I think maybe the Bank of Japan would end up being more aggressive, right? Because the government agencies in Japan have already talked about, like, hey, we don't want yen to get to like the 145s. And this is kind of like the conversation that was going on last year in 2022 when we were all the way back here in yen, right? When we were going all the way up to 150. Effectively, the government doesn't want to have a repeat of this happening on a weak yen. And it seems like Udaya is going to step in and not let this happen. So sometime towards the second half of this year, it's just more or less a matter of, well, is it at 140, 141, 142? At what price and at what time is it reasonable to assume the surprise BOJ hike or change in policy with yield curve control? Most people say the safest bet is the October meeting way out here. So there's still plenty of room that this thing could go higher if that's actually the case. But I'd say, once you start getting to like 143, it every single meeting at that point becomes 50-50 whether or not they actually do something or not. Let's see. Okay, I'm getting a few requests here on across now, pound, CAD, but also euro dollar. Let's finally get into the euro dollar. Let's get into the headline here. So if we look at the chart from yesterday, I went ahead and I grabbed a short right here. I was so happy 2 days ago to get the short over here. And now I'm like, oh, that's great. So I've been picking up shorts as we've been going up here for the last 40 pips. So I'm actually kind of curious what the daily range probabilities are going to tell me here. Oh, yeah, we're pretty much right at the threshold before you start getting the tail risks. Like this whole area up here for like the next 100 pips, that's all tail risk. And this is like the edge of where you even want to be playing, right? Nominally, like, don't get me wrong, I did take a short right here because I saw this and I'm like, oh, wow, cool. Another opportunity to get an entry above 108. And then I saw it go up here. I'm like, oh, sweet, I get to short at 108.5. And then it came up here, and I'm like, okay, time to not add any more. Time just to wait for FOMC, because I just added tiny, tiny little extra bits to try and bring my average position up. So I'll just go ahead and do this. What's my average positional price? It's 322. So this is roughly where I got my net position on Eurodollar right now. All transparency. Now, this is actually quite useful for me, this analysis, because I get to show you guys, oh, here's how I do like my daily risk management. I'm going to go ahead and check off 0.88, probably as the somewhere between 0.88 and 0.89 as a good spot for the cutoff. So I'm just plopping it somewhere around here. Let's just go with 88. And let's make this line green, because this is in expectation of a rate skip or a pause. Because if that's the case, Eurodollar's going to 109, right? Eurodollar's going to 109 if we're getting the consensus view. And let's change that to green. So this would be the bullish threshold. So past that, yeah, I'm gonna be getting out of that. I'm gonna be getting out of dollar CAD. But man, oh man, do I have some good expectations, some good price expectations if we actually get this surprise hike. And you know what? I got my risk managed. I'm neatly diversified. I'm ready and waiting for Mr. Powell to speak. And now it's more or less a matter of what are we going to do for the next 12 minutes? Right? What are we going to do for the next 12 minutes? How about I check out pound CAD or maybe gold? What do you guys think? Should I look at the pound dollar, the pound CAD, or gold? What's more interesting here, pound or gold? Well, we haven't really looked at a commodity yet. We've been looking at FX this whole time, so why don't we look at gold? Let's see here. Let's go straight to GC, which is the gold futures contract. And let's do our risk management on this for the day. Okie doke. So you're likely at the high for the day here on gold. There's definitely more downside risk if you get a hike. I'd say if you do get a skip or pause, it'd be incredibly easy to go back and see the highs of these days over here. So you're talking the 1980s here on the gold futures contracts. And for a hike, you're probably looking at the 1940s. Alrighty. I mean, that's incredibly straightforward, right? 1980s if you're risk on, 1940s if you're risk off. Let's check out pound CAD. It's asked for it a couple of times here, so I'll oblige pound CAD. And then we'll look at the pound dollar, right? 10 more minutes until FOMC. Wow. Wow. I wonder why the indicator failed to load there. Let's try going to the 2-hour chart. See if that makes it a little easier. Gives the indicator a little bit more data to deal with. I got a cat here. Are you okay? There, give me a moment. He's getting a little loud. Hey, say hey to the boy. Who's a good boy? Who's a good boy? Guy's a good boy. This is a different cat than before. It's also nice and clean too. We gave him a bath recently. Who's a good boy? Who's a good? Oh yeah, you see yourself on the screen? Yeah. All right, I'll let you. I'll let you back down now. I can see my viewership goes like this when the cat comes on the screen. I gotta bring the cats on more. You know what I need to do? I need to make sure that whenever I have the cats on the screen, I go full screen. And then my viewership will double or triple. Oh, this guy's talking about FOMC and all of his fancy statistics and trading and his great outlooks and his great trade plan and his plan to profit community and all that, and oh my god. Cat. That's what's important, the cat. But the cat is important. The cat's very important to me, at least. I love that cat. Okay, let's get into the pound. The pound CAD. Yeah, the pound CAD. So yeah, you're kind of at the edge here before you start dealing with tail risk probabilities based off of this indicator and these statistics, right? You like really once you go past like 1.689 would be the bullish threshold, and it could. I mean, I don't know what the catalyst here is on pound CAD. I mean, it's a cross. You're going to have to look at relative weakness. I mean, we could look at yield spreads and see how yield spreads are doing on this. Yield spreads are increasing. They're actually going far more positive. They're doing very, very well, actually. So it looks like the yields are net better in the UK than they are in Canada. So I don't know. I feel like on a Fed hike, these yields would move in favor of Canada because Canada does, it's America's hat. And America's hat gets some of America's benefits when they do hike. I'm kind of spitballing here. I have no data really to back it up. I'm just theoretically guessing, based off intuition, what could be happening. But yeah, if the U.S. FOMC does do a surprise hike, I'd expect the loonie, America's hat, their currency, to see some benefit out of that in the cross pairs that are being traded. But I'm not too sure when it comes down to pound. I'm not too sure when it comes down to that when it comes down to the cross against pound. But yeah, it looks good so far, right? Well, we're gonna have to reassess in about 5 minutes. FOMC's in 5 minutes here. We're about to find out if I'm really, really right or really, really wrong. Oh wow, dollar CAD is up like 20 pips in like the last hour or so. That's quite good. That's like pretty good. Maybe I need to add into my dollar CAD here just before FOMC kicks in. Nah, that's greedy. That's greedy. That's greedy. Again, thank you all for deciding to watch me here during FOMC. It means a lot to me. I'm a pretty small channel. Like, subscribe, advertisements, all that stuff. Join my trading group, buy my indicators, damn it. But a great way you can support me is join the Plan to Profit Discord, chat with everybody in there, post your trade plans, talk about the trades that you're doing, ask for requests from me, talk with me about some of the things that I'm going over during the streams. And then I stream every single day. Today was a later stream than usual. Usually I stream at 4:30 Pacific, 7:30 Eastern every single day from Sunday to Friday. And then on Saturdays I have special trading group only trade plans where effectively in an entire hour I do trade plans for the entire month and the entire week ahead before the trading week starts for every single asset I can possibly do analysis on inside the span of an entire hour. And you'd be surprised how, if you have a probability that says you're going to be correct 80% of the time on this trade, your win rate slowly approaches 80%. So, it's good stuff. Good indicators, a good life, good friends, a good community. And I wanted to say thank you all very much for watching and deciding to watch me during this FOMC. So, 4 minutes remaining. 4 minutes remaining. I want to go over pound dollar now. I think that was the next thing that I promised. Oh my god. So there's some notations I have here. Oh wow, that was wrong. But that was right. Oh yeah, I really liked that one. I went over this yesterday. So you could see how these bearish threshold trade plans sort of work, where it's like, hey, once you go past here, you're dealing with falling knife situations, right? So that's what I mean when I say bearish threshold. This is like, it's a falling knife at that point. Once you start going past here, your risks, the main risk is you don't know where you're going to end up, whether you're going to end up right here or right here or right here. You're just going lower and you don't know how low. A lot of uncertainty once you start crossing the bearish thresholds. I had a bearish expectation right here. Trade didn't work out. All right. 1L. 1L. But now we're up, and away right here. Let's go ahead and check out our range probabilities. And I won't delete this line, right? It's there. That's how the timestamp arrows work. Alrighty. Where are... Alright, that's looking a bit weird. Let's try reloading that. Why does it look like that? It's another graphical glitch. Anyways, we can at least do analysis here on the upside. I'll figure out what's going on here. Sometimes there's some funky data going in the back. Either changing the exchange that you're loading data in with this, or changing the look back works, and changing the look back worked there. Alright, so either you're getting your low, probably reversal down to here. I'd say you're probably going to get your low here if you get a hike. Otherwise, let's see here, would be like 127.3 if I can just eyeball this right. It's like 1.3, 27.25. That would kind of be the threshold. Yeah, that's definitely tail risk situation. Yeah, that is your rate cut bullish threshold. Or rather, rate skip bullish threshold. So, yeah. If you're expecting the consensus view for FOMC, which is now literally coming here, you should be hearing it right now on the stream. I gotta get over the financial juice like right now. Did they do it? Nope. They paused. But then why is dollar getting so damn strong right now?
At the end of 2023 and
What is going
4.6% at the end
on
of
here?
2024. The Fed holds benchmark rate at 5 to 5.25% target
I got
range,
financial
and
juice
the
on the
FOMC
stream right
vote
now.
was unanimous.
Don't worry, that's coming from me. I'm trying to figure out what is going on. All right, I'm gonna real quick open up the 4-panel here.
The Fed will continue the same pace of reducing Treasury and MBS holdings, and economic activity expanded at a modest pace. The Fed says jobs gains are robust and the unemployment remains low. Fed median rate forecasts rise to 5.6% end of 2023 and 4.6% end of 2024.
Official Fed funds median is now 50 basis points higher. The
Fed
forecast
officials
is
see
50 basis points higher.
core inflation at the end of 2023, 2.6% at the end of 2024. The expected rate path
is now much, much higher.
Upside in the dollar, downside in S&P. US short-term interest rate futures drop after FOMC decision as traders price in more Fed rate hikes ahead.
Guys, what assets do you want me to be looking at here right now? No hike, but it's hawkish because the expected rate path is much more hawkish than people were anticipating. So we're going to go ahead and actually check out those. So yeah, they did skip. They did a skip. But instead of effectively
Fed
saying,
swaps price in a higher peak policy rate of 5.35% in September. Yield on 10-year US Treasury notes rise after the FOMC leaves rates unchanged, last up 0.2 basis points at 3.841%, and the yield on 30-year US Treasury notes down 2.9 basis points, last at 3.912%.
Yeah, the September odds are now a lot higher. So, wow. So, I'll have to eat this. I have to say, guys, I was wrong. I was wrong anticipating that they'd hike now. However, I was right in saying over the last 2 weeks, rather the last week and a half, ever since I anticipated and correctly called, right? Effectively, I got 2 out of 3. I got 2 out of 3. I called the Bank of Canada rate hike. Surprise. I called that one. I called the Bank of Australia rate hike surprise. And now I was calling a FOMC rate hike surprise. However, that didn't happen. So I got 2 out of 3. Okay, I got 2 out of 3. However, what I was right in my expectation, one of my reasonings for my expectation of a FOMC rate hike surprise.
We have posted the FOMC SEP report for the 14th of June 2023 on the feed for all those interested.
Thank you very much, Financial Juice. I'll go ahead and mute them right now. And I'm going to bring up the summary of economic projections right now on the stream. Okay. Alrighty. The longer run projections represent each participant's assessment. Okie doke. Change in real GDP expected to go up. Unemployment rate expected to go up. Gonna keep a sharp eye, make sure that there's no reversals on my positions here, because now I'm very happy on all my euro-dollar shorts right now. All my euro-dollar shorts are singing and a-dancing right now. All my euro-dollar shorts, I'm doing quite well on those. So let's see here. PCE inflation, unemployment. Yeah, unemployment's not doing so hot. Core PCE inflation coming down slowly. Here are our Fed dots. And you can see this is the main problem with this is the so see right here 5.5. So this is saying, hey, we're probably going to get like at least we could get another 50 basis points of hiking here. So the Fed funds, or rather the Fed watch tool from the CME, here are the September odds. And we're going to have to wait till the end of day till these things update. But yeah, the September odds are going to get moved up. And so will probably these July odds. Let me real quick head on over to, is it Twitter? Oh my God, my positions are doing incredibly well right now. Oh my God. Look at this bottom right one on my Eurodollar. Oh boy, I am happy. I am one happy camper. And look at that bearish threshold. We didn't cross it. Bitcoin now going back to the bottom of the linear regressed range over the last week. Thank you all so much for watching me. I really appreciate it. Hopefully I'm going through and trying to cover enough stuff here. Oh my God. So no, through the Bank of Canada and Bank of Australia rate hikes I've been calling for like the last 2 weeks, I was saying, oh, this is going to push up the expected rate path higher, the terminal rate path for the FOMC higher. So I'm going to anticipate a Fed rate hike surprise at the meeting that just happened. And we didn't get that. But I was correct on that fundamental assessment of, okay, the terminal rate path is now substantially higher due to those dot plots. Oh man, I'm one happy camper right now. I am one happy camper. So my fundamental assumptions were right. The exact call I was making wrong. The dot plots saved me. Saved by the dot plots, right? Instead of saved by the bell, I'm saved by the dot plots. Man, oh man. So yep. End of day, it was a hawkish expectation. I got 2 out of 3 of my calls correct. And net, if it comes down to portfolio performance and execution of my trade ideas, I'm 3 out of 3, baby. I'm still 3 out of 3. So, guys, that is FOMC. If you want to join my trading community, see all my fancy indicators, follow my trade analysis, and how I can help you become a more competent trader when it comes down to reading trade research, going through the outlooks, covering a wide variety of different assets, come hop into the Plan the Profit Discord. Go ahead, ping me at Joe Baus. And by the way, Discord just pushed their new, I'm making money, Prince. Discord just pushed their new username system. So now you can do at Joe Baus from anywhere. And you'll always get the real me. I had a problem where I had to ban 50 bot impersonation accounts. Even though I'm a pretty small guy, as far as like channels and subscribers and all that, I had like dozens and dozens and dozens of bots impersonating me and trying to sell crypto to people. Oh man, ES is getting hammered right now. Look at that, man. Let's go down to a 15. That is not the greatest of reactions. The NQ not doing so well. Now, what we're about to look at, this is the weighted index of the top 10 holdings of the S&P 500. So this is Apple, Microsoft, Amazon, Nvidia, Google, the other Google, Berkshire Hathaway, Meta, Tesla, UNH, and this is how they're all reacting right now. This is the top of the top when it comes down to equities, right? So this is the top 10 in the ES, and of these top 10, 7 of them are in the NASDAQ. So this is not a pretty sight in the last 15 minutes. We're currently down 0.5%. At most, we went down a full percent. And now it's more or less a matter of, do we continue? Right? The question is, do we continue lower? Is this enough to snuff out this rally? Because we're also getting the refill of the TGA, and a lot of people have been worried about how that's going to suck up liquidity. Well, we're probably going to get a hike in June and another hike in August, September. We got to be careful going forward when it comes down to the risk-on plans. But man, did I do well today or what? Did I do well or what? Okay, doke. So now's a good time for requests. If you guys want me to go over any particular chart or go over any particular topic, whether that's, trading psychology with the SDT framework stuff, when it comes down to my indicators, these fancy big old boys here with these statistically based range indicators, and it looks like we might have bottomed out actually for the day on oil. While oil is still negatively reacting, I'd say, if you go past 68.50, that's probably when you got to be concerned about lower lows in oil for the rest of the trading day. So if you want to ask me more questions about these indicators and how they work and how I'm able to come up with all of my, trade plans here, and explicitly how I was shorting Eurodollar on this ride up and doing such a great job now on, look at this, even my trade here on dollar CAD is now in the green. I think I've done a pretty excellent job of doing good interpretations and good risk management on my trades for the last 3 days, live here every single day for the daily, plan the profit streams. So let's see here. What's the first question? What's the first thing you guys want to know? What are your exit points for your positions? That's for everyone in the trading group. I got some big expectations based off the monthly targets of range probabilities, right? This indicator right here in the bottom left-hand side, and with another indicator called pivot probabilities. And I'm using a combination of those two to come up with targets, long-term targets for the month ahead that I have expectations that will more likely than not actually reach now. I feel based off how FOMC went today, I think we'll hit those targets. I'm prepared for US dollar to start making some ground, and for these trades that I just talked about that I have on to start doing well. However, are we going to hit those monthly targets? Maybe if we get one or two more things that kind of go in our favor, right? For example, later on in this week, we still have the ECB meeting. Don't forget, there's still other macroeconomic events that have yet to occur for the rest of this week. We're in Tuesday, my man. It's Tuesday. So, oh no, it's Wednesday. I'm still thinking that it's the 13th of June. So I get up. I'm on the West Coast, just FYI. I'm here on the West Coast, and I get up at like 2 a.m., right? I get up at 2 a.m. I go to bed like at dusk, at sunset. So then every single day, I'm ready and totally prepared mentally. I have no grogginess. I had my breakfast. I'm doing all my morning stuff. I am ready for you guys for the morning streams right away every single day. And I'm sharp like a tack. Now, when it comes down to today, we still have Thursday and Friday to get through. We still have Thursday and Friday to get through. And there'll be 2 more streams this week, so subscribe if you're not subscribed already to Plan the Profit so you can get the daily plan streams. Let's see here. What are your exit points? Again, that's going to be for the trading group because I have some longer term monthly targets for the trading group on my trading expectations. Let's see what else we got here. Bearish threshold for the EU and GU. Okay. Let's go ahead and do that then. I wouldn't even say that maybe the low for the day could be in. I'd say the point where you start to have a lot more uncertainty is on this day if we start going below 107.5, which is like 60 pips lower from here. Below here today. No, not on this style of news and not with ECB coming up next. GU. Keep asking the questions. Keep asking me whatever you guys want me to check out. And I will be checking out gold for you here, DJ, real quick. Let's see here. Yep. So this wasn't really a skip. While the Fed did skip, but their forward guidance was especially hawkish. And by especially hawkish, they were saying, oh, we're going to do another 50 basis points of hikes, potentially. And that's enough to kind of deter, like, okay, we want to be bullish right now, but we were expecting there to only maybe be one more hike, and that's it. Or for the Fed to say, we're not anticipating any more hikes. For them to say we're going to do 50 more basis points of hikes is really not consensus for risk-on traders, for equity bulls. So while the skip did happen, the forward guidance was so hawkish with additional higher terminal rate hike path, it just totally reversed it on the day. As far as the threshold, I mean, literally, the threshold's just the low of the current day. Once you go past this low, maybe you'll start talking about seeing prices of 125.80. That'd be my first conservative target, is if you're anticipating lower prices on the day, I'd look for first a break of the low here, and then anticipate a move to 125.8. That's how I'd look at it. Okay. Last question here is gold. Gold. Oh man, my trades are doing so well. They're holding up here. Dollar strength is holding up here so far, so good. Okie doke. Yeah. Top for the day is in. Yeah, top for the day is in. It's going to be a bit hard to tell where the low is going to end up. Again, you could end up at the 1940s on an aggressive expectation, or the 1950s if you're being more conservative. However, if you're just expecting things just to go fall and fall and fall like a falling knife, once you get past 1930, this is when you start dealing with more falling knife sort of odds on the day. And I don't think you're going down $20 on the day. So the low could be in technically right now on gold. But if you're anticipating lower lows from here, the mid 1940s looks reasonable if you're especially aggressive with your trading expectations for short gold. I don't think I'd have those expectations. I'd stay with this conservative target, so I think maybe trading is done for the day on gold. And the next best opportunity for gold will be maybe to trade it tomorrow, or if you want, you can go ahead and join the trading group And when you join the trading group, you get access to all the indicators that I have, plus access to me one-on-one, so I can show you how to use this stuff. And then we can go over weekly and monthly trade plans with these indicators and do exactly the same analysis here, but on higher time frames. So you can look at swings, right? And I can just show you how to interpret these indicators and find the thresholds. And then from there, you can make your own autonomous trading decisions with a higher degree, maybe of certainty, because you'll have some indication, right? You'll have some statistical probability indication, and with a real statistical distribution behind it, not like, oh, let me simulate this wishy-washy, empirical thing. Like, no, this is an actual probability distribution. Powell's speech is in 10 minutes. Thank you so much for reminding me, Pascal. We'll go ahead and do that. We'll go ahead and we'll definitely wait for Powell. Guys, do you want me to have Powell up here on the stream? I'll watch him. And actually, you know what I'll do? I'll put Powell in like a little box above me, and we can have the charts in front of us. So let's see here. Let's do euro dollar, more impressive trade. Let's put, so that's crude, and then NQ down there. All right, so we got all the major assets here. All the major assets on the chart. Now let me go ahead and do a screen capture of good old friend Mr. J. Powell. And again, thank you guys for deciding to watch me. Only so many people here, but you know what? I'm happy that every day, every other day that I go and I stream, there's more people watching. And I'm incredibly grateful that you guys are entertained and educated and informed by all the stuff that I'm talking about. It shows me that when the stream is growing, that people are sharing it, or YouTube's recommending it more. Thank you guys for watching. I'm pretty certain maybe in about a month or two, I'm going to have like 20 people watching me consistently. More people are going to be in the trading group. More people are going to be using exactly the same methodologies to make my trade plans. You know what the cool part is when you're doing trade plans with statistically based indicators, if you're doing the statistical interpretations correctly, everyone who does them correctly is going to end up with exactly the same trade plan, or roughly the same trade plan with like a bit of variance. That's the cool part when you decide to use trading tools, is that it doesn't matter who has them, so long they're interpreting them correctly. Everyone has the exact same trade plan. It's freaky. And I've been doing this for like 2.5 years, 3 years now, with people in my trading group, with my statistical indicators. It's just like, we used to do meetups every single week. There'd be 5 people in the trade group. We'd go one after the other, and we'd all have exactly the same trade plan, exactly the same risk management. And at that point, it's like, well, now our meetings are just like DMing each other like, hey, do you see yeah. Hey, do you see this? Yeah. Have you thought about this? Yeah. It doesn't, like, some people, they look at it and an hour later, they know everything. It's insane. Like, they learn insanely quick. And some people, it's like, okay, just once a day or once every other day, because you're in the trading group, we get to talk to each other. But still, even if you don't want to be in the trading group, you can hop in to the Plan the Profit Discord for free and get some amazing trade research from some of the most powerful, smart people who manage hundreds of millions of dollars, or are responsible for managing hundreds of millions of dollars for free. And it's public facing free research. This isn't like you're going behind a bank's paywall and ripping proprietary research from. Like, no, this is like from a bunch of institutions who are just putting this stuff out there and saying like, hey, anybody want this stuff? And it's one of the fastest ways to get smarter at trading as quickly as possible. Yeah, man. So there's a lot of great stuff that can come out of the Plan to Profit Discord there. It's called the Outlooks channel if you wanted just to go straight to that stuff. All right, so I got a little box here, and when Powell comes on, I'm gonna give him a spot just directly above me. Powell's gonna have his own webcam box. Oh man. So far so good. We're gonna have to see how Powell is doing. Yeah. I'm not sure. Like I said, I'm gonna maybe hold judgment here. I agree with Pascal and chat, and I also agree with you, Mouse. And I'm kind of split right now because we don't know what Powell's going to say. Powell was kind of neutral going into this FOMC. So whether or not he'll be super hawkish or he'll be super dovish, I think he'll just be moderate, right? I don't think we're going to have any major signal. At least that's just my baseline expectation based off the prior research I've done on things that Powell has said going into this FOMC. So I don't have a particularly strong bias, but if I were to have one, it would be on the hawkish side. It would probably be on the more hawkish side. I don't Powell has flipped and become a dove, but then the question becomes, well, to what degree of hawkishness do you anticipate he'll be? And that's an open question, right? That's a huge open question. Real quick, let's see what's coming down the squawk here on Financial Juice. The press conference with Powell is going to begin in 2 minutes. Less than 2 minutes. The press conference is about to begin in less than 2 minutes. Almost forgot I had a little bit of oatmeal there. Boy, am I ready or what? I don't know. I still feel like I kind of lucked out because I was so confident that they were going to still do a hike, but they effectively did a hike in their future terminal rate on the FOMC. So I don't know. I feel like I lucked out today, guys. I just feel like I lucked out today. I really wanted to be 3 for 3 on my surprise hike calls, but at least I'm 3 for 3. 3 for 3, that's 4. 3 for 3, 3 for 3, one of these, not that. That. On Power should be starting like right about now. Yeah, 3 for 3 on profitable trades and profitable trade planning. That's what we're here for, right? This is plan the profit. You want to come here and I mean, I could say come here and make money, but come here and we're all here to make our own decisions on how to make money, right? You always got to put that little asterisk in there because, well, that's the truth. No one through YouTube can reach over into your brokerage account and press the buttons for you. So it's best to learn as much as possible, get access to the tools that you need, and most importantly, be around people who are good to be around. Oh, here we go. How do you guys like that? The little Powell preview window. Do you guys think that's cool? Do you guys think that's cool with like having the little extra window up there like he's a guest star or a guest viewer?
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Hawkish.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy
Negative
interest rate
reaction
by
on
5
euro.
percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening
hawkish.
policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to
NQ
leave our
getting hit.
policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as
NQ getting hit
likely
again.
that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace.
Hawkish.
Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
Oh, NQ got hit
Committee
again.
participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%.
A little bit of a
There
bounce
are
in
some
NQ
signs
now.
that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year.
Dow
While
got
the
hit
jobs to
especially
workers
hard.
gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation.
Dollar getting some strength.
The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025.
NQ getting awfully close to
Core
15K
PCE
again.
inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a
Bitcoin
broad
getting a
range
rebound.
of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high
NQ below
inflation imposes
15K.
hardship as it erodes purchasing power, especially for those least able to meet the higher
Bitcoin
costs of essentials
doing more
like
rebounding.
food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
Hawkish call on inflation.
As I noted earlier, since early last year, we have raised our policy rate by 5 percentage
Dollar
points.
weakening.
We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds
Hawkish
from tighter
call.
credit
Dollar
conditions for
strengthening on
households and
that.
businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain.
NQ defending 15K back to
In light of how far we've
15,022.
come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But
Another
at this
hawkish
meeting,
call.
considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to
This is
return
important.
inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments.
Very
In
neutral.
our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a half percentage point higher than in our March projections. I hasten
Dollar
to add,
continues to
as always,
weaken.
that these projections are not a committee decision or
Bitcoin
plan.
rebounding.
If the economy does not evolve as projected,
Oil still
path for
following.
policy will adjust as appropriate to foster our maximum employment and price stability goals.
NQ holding
We will
15.
continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you. And I look
NQ
forward to your
holding.
questions.
DXY is now at 103. Oil is continuing to fall. Bitcoin is rebounding.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated.
Let me guys know what you
sectors
think.
like housing, while they felt the drag
I'm reading the chat
of
right
the
now.
past Fed actions,
Oil opened
have started to
lower
recover
here on
in
the
some
next 15 minutes.
regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables.
Oil just made a new low. Dollar's going lower too. Bitcoin's continuing to rebound higher,
but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July 2 things. 1, decision hasn't been made. 2, I do expect that it will be a live meeting.
Oil's now making new lows, getting closer to the 68 flat.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots. Stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the
consistent, but on the high side of expectations.
The last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all 3 of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting.
Hawkish.
So, although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the 3-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation.
Bitcoin continuing to rally higher. Dollar broke below 103 just now.
Housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's again probably going to come slower than we would expect. That leaves the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector.
Moderately hawkish.
I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
A wait and see, data dependent view.
Nick Tamaros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant,
And
but
you making
I
a good
don't lose weight
rebound.
just by buying a gym membership. I have to actually go to the gym.
Up 60 points here.
16 of your
44
colleagues
points
put
in the
down
last
a higher
50 points in the
year-end
last 15
23
minutes.
rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the
Dollar
S&P,
reclaimed
that is our
103.
estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed
NQ
was
just
very
tapped
important last year.
15.1.
As we get closer and closer to the destination, and according to the S&P,
Oil looks
we're
like
not
it's
so
about
far
to
away
bound.
from the destination
Rebound
in most
here.
people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are
Moderate the
benefits
pace,
to
if only
that. So that
slightly.
gives us more information to make
Bit
decisions.
dovish.
We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only
Okay.
one June
That's
employment,
pretty dovish.
with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the
little
committee be using
Freudian
to
skip,
inform their judgment
right? A little
on
Freudian
whether
skip.
this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you can from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate? Or do you
Dollar
think it's
continues
possible
to
we could
fall.
have
It's now
even
at
a higher
102.9.
5.6% terminal by the end of this
NQ
cycle?
is holding its gain.
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. it's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, we always write down at these meetings what we think the
Dollar continues to fall.
appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually, in reality, wind up being lower or higher. And there's really no way to know. But it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place. But it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Ooh, that's a bit dovish.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6 years for sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively 0 now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet, because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data,
dollar
you
reacting
just aren't seeing
positively
a lot
to
of
that.
progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. Sufficiently, so I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, with more data over time.
Rachel.
How are markets
Hi, Chair
reacting?
Powell.
Dollar
Rachel
is
Siegel
still
from the Washington
holding
Post. Thanks for taking our questions.
off that comment.
I wanted to ask
Bitcoin's
further
coming
on
lower.
the lag effects.
NQ is
When
still
you're
holding,
considering
trying to
when
fight
you
for control
would
over that
hike
15.1
again
level.
throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would
expect dollar
inform
to
your
get a lot
decisions?
weaker
Have you
on
learned things
that
over the past
answer
year that
sheet.
give you some sense of timeline for when to
Fact that
expect
it
those
didn't.
lags to come
Whoa.
into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking
NQ
about lifting off. By the
getting
time we had
a
lifted
lot
off
stronger now.
the 2-year, which is a pretty
Finally
good estimate
broke
where
through
policy is going, had
15.1.
gone from 20 basis points to 200 basis points. So in that sense,
Oil's going to
tightening
close the
happens
candle green, it
much
looks
sooner
like.
than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is
The dollar continues
interest-sensitive
to
spending
shed
is
some of
affected
its
very,
strength.
very quickly. So housing and durable goods and things like that, but broader demand and spending and asset values and things like that, they just take longer, and you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, then that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons
this
why
seems positive.
it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
Dollar clipping back some of its
Give us an update on
gains.
what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And
Apple
if
looks
we
exactly
were to
like
see
NQ.
what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions.
The
So
Dow is yet to
that's,
recover from its
how we
massive
think about it.
drawdown today.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low.
Gold
in the
is
past
getting
couple of
hit
months.
right now.
And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah, so, we've, remember, we've
Ethereum not
We're
holding up any of its strength right now.
2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running, and it's running at
That's
a level,
hawkish, of course, PCE
over 4.5%,
inflation.
far above our target, and not really, moving down. We want to see it moving down decisively. That's all. We're, of course, we are going to get inflation down to 2% over time. We don't want to do. We want to do that with the minimum damage we can to the economy, of course. But we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned, you did
Everything's
see
kinda
wages
holding its
driving
current
inflation,
price.
And there was some research from the San Francisco
Oil
Fed
losing just a
suggesting
tad of
wages
strength.
aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically? of how
Dollar's
you
finally
see
green on the
tight
15
labor
minute.
market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank, and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of
NQ
that high demand, to
continuing
some
up.
extent, supply chains got all snarled up. So prices went way up, inflation went way up.
But so
That
is the
was
dollar.
the origin, and it wasn't really particularly about the labor market or wages. But as you move through 21 into 22 and now in 23, I think many
Oil trying to hold in
analysts
there.
believe that it will be important, an important part
Ooh,
of getting
Bitcoin just
inflation
got
down,
smacked.
especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual
NQ made a
pace.
new high
So,
for
and
the
that's,
hour.
That's
NQ looks
a
like
little
it's
bit
going to
of
survive here.
the finding of the Bernanke
NQ on the rise.
paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Let's go to Michael McKee. Michael McKee from Bloomberg Radio and Television. You said in the past that you don't like to surprise markets. It's kind of been the Fed's view. Markets should have an idea of what you're going to do before you go in. You also said a number of times that it would take a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function. What will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move?
Listen.
Because you've said you feel you need to. Is it time that's going to require additional movement, or will
Oil
it be
rising
a
on
reversal
this.
in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data. You'll hear Fed people talking about it.
Risk on
and then
reactions
markets will
here.
have to
Dollar
make
continues to
make a
fall.
judgment.
Oil continues to
Do you
rise.
think
MQ
inflation
continues to
is
rise.
likely to continue coming down based on the lags and based on your threat of additional movement? Or are we going to be in a period where we're not going to know what's happening?
I think if you look at, if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down. And that's the number one thing. So that's how I think about it.
Moderately hawkish.
Victoria. Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that,
Dollar
of course,
taking a
we've been
hit,
very focused
but
on that
so
for a
is
couple of months,
NQ,
as everyone has.
and
Treasury has laid
crude
out
is
its
holding in there.
borrowing plans publicly. I think I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year.
NQ red, everything
so
holding.
That's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of, I would say, the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something that we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecast, and how does it factor into monetary policy?
Oh boy. Oh, boy.
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either held by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. You know, we're watching that situation carefully. I do think we will see rents,
dollar gaining some strength,
and house
so is
prices
Bitcoin
filtering into housing services inflation, and I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, you know, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about, in the past, about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as
good,
you know, the
good on
judges
Powell.
of appropriate fiscal policy. I will say, and many
Trying to
of
stay
my
politically
predecessors
neutral.
have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into
dollar
into that
falling,
with
Bitcoin rising
lawmakers would be kind of inappropriate given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell.
NQ following in reaction
so looking
to that.
at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
You know, I would just say it this way. I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see, the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and we'll do whatever it takes to get it down to 2% over time. That is our plan. And you know, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time. But when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, you know, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate,
Everything's
the
still
nominal
holding its
rate
current
at that
price?
point, 2 years out, let's say, should come down just to maintain real rates. And actually, you know, since we're probably going to, we're having real rates that are going to have to be meaningfully positive and significantly so for us to get inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a
Hawkish.
single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It has not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
We're going to have to keep at it. It's hawkish. Everything's still kind of holding its same price, though, after that.
Hi, Chaparral. Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about, there are long-standing differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal. And so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic lows, historic modern lows here. So we're still talking about, I mean, what is as strong a labor market as we've seen in, you know, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, you know, as a factual matter, that's correct. We do need to see, you know, rents bottom out here or at least stay quite low in terms of their increases, because we want the, you know, we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And you know, the committee, people in the committee, the median
Everything's
went up
still holding
significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and that's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So we you know, what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And you know, we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. but we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Greg.
Thank you so much, Chair Powell. Greg Robb from MarketWatch. I just wondered if the committee has talked at all about the labor market and
prices are unchanged.
There's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, we have some workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
Probably not.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very, labor economics, you know, and the labor market are utterly central. You know, it's half of our mandate. So we spend a lot of time talking about that. I think, you know, there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on. But we're not, you know, we're not
oil going up,
in
dollar going up, and Bitcoin going down
over strikes and things like that. But we, you know, we look and we see what's going on, and you know, we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about. Most folks would say now it wasn't really about that, about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
Oil clawing back.
So,
NQ ready to make new highs on the day?
We're trying to think where to start. I'll start with commercial real estate. We, of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. You know, it feels like something that will be around for some time, as opposed to you know, something that will suddenly hit and you know, work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and you know, clearly in the pandemic, it really was.
Getting ready to make new highs for the day on the NQ.
Financial sector where issues really arose, and you know, there's a lot of work going on with the administration, in particular, leading that to try to address issues in the Treasury market and in all kinds of areas in the non-bank financial market. But you know, our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. You know, in terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. You know, our job generally involves worrying about a lot of things.
Bitcoin continuing to fall.
That would include
oil finally rebounding here.
Identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, you know, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
The dollar is rebounding.
Do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, And that also is a factor that we're always going to be considering. Thank you very much.
All right, let's see the end of meeting market reactions. All right. I don't know if we have any opinions going on in the chat now, but I would love to see what everyone thought of the meeting. And did you guys enjoy the commentary? Oh, 10-minute delayed on this data. Gotcha. Oh, and delayed on this one. Let's see. I'm looking for the one by Owanda. Let's see. Let's just go with U.S. oil. Oh, it's just no difference. A lot of movement on NQ, but it's effectively flat right now. All right, we're going to watch the post-market reaction here for about another 10-20 minutes. Again, thank you guys for watching FOMC with me. This has been by far my most watched stream. I hit a new all-time high in concurrent viewers, 12 people. And yesterday I hit an all-time high of 10. I wonder if tomorrow I'll hit another all-time high. So thank you guys for watching. Like, subscribe. I'll be here tomorrow for the New York Open. And we'll be going over FX, commodities, crypto, equities, and the bond markets all around the world. I can see crude is still hopping on up. Same thing with the NQ. Bitcoin made a rebound here. Alrighty, my man. Well, it seems like everything's gonna continue to trade flat for the meantime. We're gonna give this another 20 or so minutes. We're gonna see how this plays out post FOMC. And in the meantime, keep sending some more chats. We can do some chart requests in the meantime. So if you want me to go over some charts to see the analysis, see the reaction on some different assets than the ones that I've had up here, go ahead, send a message into the chat. I'll go ahead and bring it up. If you want me to look at a different crypto, a different equity, a different commodity, a different currency. Overall, my view is that that was neutral to hawkish, and that seems to also be the consensus view. However, the view from more sophisticated traders turns out to be like, oh, he just says, yeah, we're hawkish, but our hawkish promises are sometime in the future, and we may or may not actually act on them. So, effectively, the Fed is saying markets just do your thing, just don't get too crazy and help us deal with the inflation. Otherwise, we will have to hike. Oh yeah, and everyone on Twitter is talking about I shouldn't have called it a skip. The Freudian skip language. That was my favorite part. The Freudian skip. So yeah, this definitely was a skip. Which one was Bitcoin correlated to today? I'd say NQ. Well, understand that DXY up here, which is the dollar, is pretty much the inverse of what's going on with Bitcoin and the NASDAQ. Although the NASDAQ is moving with a lot more volatility than, in my opinion, Bitcoin or the DXY. However, Bitcoin and the NQ are probably both moving the most similarly across all four of these charts here. James wants pound dollar. Well, I'll give you pound dollar. All right, well, pound dollar seems like it is successfully rebounding right now from the dollar strength. So Powell started talking right around here. And you can see how markets are going more risk on as Powell kept talking and talking and talking. So we're going to have to wait and see. Again, I'm going to give this another 15 or so minutes to see how this plays out. If you guys want to continue trading this thing along with me for the rest of the day, hop into the Plan to Profit Discord, links in the description, and get into the voice channel or post some charts into the trading channels for whatever currency or market, equity, currency, crypto that you're trading. We'll look over it together. We'll do some more analysis with some of the other guys in the group. Still holding on from 2560. Well, 2560 is pretty... Yeah, that's like 100 pips lower. So I think the question is there more downside here? And immediately, I'm not too sure. I would just want to be careful going into the day ahead. However, net, I think the end result is that we're going to see some more risk on from this meeting. Net, that's what I expect, that we'll see a bit more risk on from this meeting. Crude oil making new highs, continuing to rebound. Very, very good sign for oil right now, that it'll at least probably get close to the $69 area. It hasn't rebounded as strongly as some of these other assets have. But outside of equities, Bitcoin's not doing so hot. Pound dollar's not doing so hot. Oil, we're going to have to wait and see, but yep, it's going to continue to go a bit higher. Higher. And the dollar is continuing to rebound here. Dollar is continuing to gain some strength here. So I'll be closely watching the FX space and the crypto space and the equities space and a couple of bits of the commodity space over the next couple of days, especially with the ECB meeting that we have ahead of us. And we have a few other macro events ahead of us. And I'm absolutely certain I'm going to be getting outlooks and research from a bunch of trading institutions on those events that are immediately coming up now that FOMC is behind us. You know what? Before I end the stream, because now, we're going on here for like 2 hours and 15 minutes now. If you guys have been watching this long, I'm going to see what I can do to get some additional information here. So, yep, hawkish hold. I'm just going to go over some of the titles of stuff in my inbox here. Hawkish hold, hawkish hold. FOMC skips June, but signals a hike. Yeah. So, I may have to take back my expectation that maybe towards the next couple of days, it's sort of risk on-ish. Look, like what Powell said wasn't particularly revolutionary. This skip was 100% the consensus expectation. But the forward guidance estimating that they would do at least another 50 basis points of hikes, that's really what has everybody, getting ants in their pants right now. Nobody likes that idea that, Fed's going to do a hike in July and then they're going to hike again in September. And then by the time we get to the fourth quarter, they may continue to hike if things don't materially improve with the core numbers. Yeah. The good part, though, is the Fed's outlook on recession, which is that they think they can get inflation down without a recession. So right now, everyone is still calling a recession. I even have my whole recession jinx theme, which is just as everyone is not expecting a recession will occur, right? Everyone will get jinxed into thinking like, oh, a recession's finally not going to happen. And then, boom, there comes one. I think now is the time to step away from the charts and the end of the stream and to go into the Plan to Profit Discord and do some trade plans and read some research. Because I have been sent literally 50 emails throughout this whole stream, and I'm going to be going through them, and I'm going to post all of the outlooks that I've been sent from trading institutions, from big banks, and then I'm going to go over them tomorrow. So if you want to hang out with me as I go through these outlooks and talk with me about my indicators, about my analysis, about my own trades, about what you're doing, come hop into the Plan to Profit Discord right now, and I'll be in there in the trading room for about the next 30-ish minutes. All right. So, with that said, thank you guys for watching. I'm Joe Baus. I've been your boss. And this is Plan the Profit, where we do our trade plans every single day, 4:30 a.m. Pacific, 7:30 a.m. Eastern. I now have an official schedule. Thank you guys for watching. This has been my most popular stream yet. Every single day that I have been going live, I have been getting more viewers and more likes and more subscribers every single time consistently now for the last 2 days here. So this channel has been growing, it's been popping, and I have you guys to thank for your time and your appreciation for everything that I cover. Alrighty. I'll see you guys in the Discord. I'll see you guys in a bit.